Hello all, welcome to my channel. So this will be a series called Financial Statement Analysis, and this is the part 1. So in this I will discuss about the three statements, and then we'll move on gradually to what ratios can we see and analyze. And then finally we'll look at some charts on the basis of the ratios or the metrics that we've calculated. So let's get into the part 1 first of all, and let's see what the three statements are. The company that I'll be covering here is called the Interglobe Aviation Limited. So this is also called as Indigo Airlines. This is an airline operator based out of India. And for the analysis, I'm taking the consolidated statements or the consolidated numbers here. So let's start with the income statement, or as we call it as the profit and loss statement. So this depicts the revenue that is generated by the company by selling the products or rendering the services to the customers. And those products and services are basically the core business of the company. And after those revenue, we have certain expenses, and also there will be certain expenses which will be inherent to only some sectors. We'll talk about those as well. And then we have certain other expenses, and in between we'll have some profitability metrics as well. So let's start with the revenue first of all. So the revenue from operations for an airline is going to be the revenue that it generates by selling the tickets to the passengers, or generating the ancillary revenues in the form of the in-flight beverages, food, priority check-ins, money from the luggage, extra baggage, or maybe the money that the airlines charge for the seats, the preferred seats. So these sort of things. And we can also add the cargo revenue if there is a cargo division within that company. Then we have the other income. So other income is something that is not related to the core business operations of the company. It can be in the form of the financial income or a non-financial income as well. So in essence, it is not going to be something that is related to the core business of the company. So if we talk about, let's say, the financial income, it can be the redemption of certain investments, the mutual funds, or maybe the interest that the company has generated on the money that, let's say, it has invested somewhere, or it may have lent that money to some third party. So the interest income that it has generated from these sort of investments. Then we have the expenses. So as I talked about, certain expenses which are only related to certain industries. So for example, we have the airline fuel expenses. So these are going to be enormous, or basically high in nature. And then we have something called the supplementary rentals and aircraft repair and maintenance. So this is something related to the engine overhaul. So these sort of expenses. Then we have something called the airport fees and charges. So airport fees and charges for the landing and the parking of the aircrafts. Then the purchase of stock and trade, basically in flight. Then we have the change in inventories of stock and trade, the employee related costs. Then we have the foreign exchange gain or loss. And we have some other operating expenses. So in the other expenses, we can have something called, let's say, repairs and maintenance, then a rent, the fees related to the directors. Then we can also have some provisions against the bad debts or loans. There can be expenses related to, let's say, insurance. So these sort of expenses can be put under the other expenses. Now there is a profitability metric called as EBITDA, which also means earnings before interest, tax, depreciation, and amortization, and rent. So as you can see here, we have a line item called as the aircraft and engine rentals. So basically, before expensing the rentals for these leases, what is the profitability that the company is generating? So this is that metric, EBITDA. And also, as you can see, I have added a YOY change percentage, basically how much has the revenue or any expense changed from one year to the another, either it has increased or decreased. So this gives us a bird's eye view on as to how the company has been faring, whether it has been faring well or bad or worse, then certain commentary can be made using these percentage changes as well. And also I've taken the as a percentage of revenue for all the expenses, and also set the profitability metrics. So for example, if I'm talking about the EBITDA, so basically it's the EBITDA margin. So out of those revenues, how much has been generated here after expensing all these expenses. Then after this, we have the metric called EBITDA. Again, EBITDA is a very important metric, especially when we talk from the credit perspective. So after this, we have something called a depreciation and amortization expense, which is going to be the expense of, let's say, any plant property equipment over the useful life of that asset. So this is something related to that. And after expensing this expense, we have something called the EBIT, that is earnings before interest and tax. Now, EBIT is an important metric when we need to look at what has been the returns that have been generated on the capital employed or the total capital employed, because this is before expensing the interest cost basically. So EBIT is going to be a metric that will be available to all the investors. Hence, it's also an important one. Then after that we have the finance income and finance costs. So after taking into account these two line items, we have something called the PBT or the profit before tax. And then finally, after this we have the total tax expense or the provision for the taxes. So there can either be a tax expense or a credit. And after this we'll finally have the profit after tax, or basically the PAT. Or here we also have the losses, so we can also say the loss after tax. So when we talk about the income statement, it is based on the accrual form of accounting, which basically means that the exchange of cash is not the key consideration here. So even if the cash has not exchanged the hands, but still, let's say the service has been rendered, then that revenue for that service, or basically the product that has been sold, but still we can take the revenue uh, in the revenue from operations. And similarly, on the expense side, even if the company has not paid for, let's say, an expense, but still, since it has got the goods or the services from a creditor or a supplier, so those expenses can be added on the income statement, although the company has not paid the parties in cash yet. So this is how accrual accounting works. I've also added the CAGR column for all these line items. So CAGR basically means compounded annual growth rate. Now this is going to give us a single rate of return. For example, I'm talking about compounded annual growth rate for the period FY18 till 22. Now for this 5-year period, let's say if I talk about the revenue, so how has the revenue increased from this point to this point? So in these 5 years, the revenue has increased first of all 23.8%, then it increased by 25%, then it plummeted by around 59%, then again it increased by 77%. So if I need a single percentage as to how the number reached from one point to the another, then we use the CAGR. Basically for each dollar invested, in simpler terms, for each dollar invested, how has that dollar increased in value or decreased in value till another point in time. So this is 3%. So if I, let's say, calculate the future value by using the FE function in Excel, and I say the rate is 3%, I'll link it here. The number of periods are going to be 22 minus 18, that is going to be 4. Then for the payment, I'm going to put a 0. And for the PV, I'll put a negative sign and I'll link it to the initial value, and then I'll close the brackets. So as you can see, I've got the value 259,309, which is nothing but the value in FY22. So this is going to be a single rate at which this value will grow for these 5 years and will reach this value. So this is how the CAGR works. Now, after the income statement, we move on to the balance sheet here. So balance sheet consists of the assets, the liabilities, and the equity. So assets are nothing but the resources that the company or maybe an individual owns, and out of which an economic benefit is expected for the future years or the future periods. And if that economic benefit is expected for more than a year, then we define it as a non-current asset. For example, we talk about the property, plant, and equipment. So these are generally going to be long-term in nature, and the economic benefits that the person or the corporate can reap out of these assets is generally going to be more than a year. Hence, we define it under this category of non-current assets. Similarly, we have something called as current assets. So these assets are going to uh, give the benefit to the company for, let's say, less than a year or maybe till 1 year. So let's say if I talk about inventories, so these inventories are expected to be sold out within a year. So this is what it means. Again, if we talk about the trade receivables, so this is the money that is expected by the company to get from the customers is going to be less than a year. So this is how the assets work in terms of the current and the non-current. So we have certain assets in the non-current, for example, the property, plant, and equipment. So right of use assets are nothing but the lease assets, then capital work in progress, which are basically the assets that are currently not in the final stage, but they are under process. Then we have the intangible assets, which are related to, let's say, software or maybe some sort of copyright or some trademarks, so those sort of things, which is non and which is not tangible in nature. Then we have the investments, other financial assets. Then we have the tax assets and other non-current assets. For more information, one can always check the footnotes, which are present after the financial statements, and a lot of information is given about these assets or liabilities. Then for the current assets, we have the inventories, again the investments, receivables, the cash, bank balances, other financial assets, current assets, so these sort of things. And finally, we have the total current assets and the total non-current assets, which will cumulatively be called as the total assets. Then after this, we have something called the liabilities. So liabilities again are defined as non-current and current. Notation is going to be the same as we defined for the assets. Just the difference will be that in the case of assets, we were expecting an economic benefit out of those resources, but in this case, it is going to be an outflow of money, or basically what the company owes to the other parties. If we talk about the long-term borrowings, so in that case, although company is going to pay the interest on those borrowings, but again, the principal repayment will be done not within a year, but it will take more than a year. So in that case, we can define the long-term borrowings under the non-current liabilities. The same goes for the lease liabilities. Then we have certain provisions, the tax liabilities, the financial liabilities. So financial liabilities might consist of the current maturities of the long-term debt or the interest that is uh, accrued but not due. So these sort of things. Then under the current liabilities, we have something called, again, we have the borrowings, lease liabilities, but these will be paid off maybe within a period of 1 year or before. Then we have the payables. So this is what the company owes to its suppliers. Then other financial liabilities, again the provisions and certain tax liabilities and other current liabilities. And after the liabilities, we have something called the equity. So equities is the money which is infused by either the promoters or the shareholders of the company. And equity is generally comprised of four main parts. First, we have the total shares outstanding. So the value of that is calculated by multiplying the total shares, those which have been issued to the shareholders by the face value of the shares. Then secondly, we have something called the retained earnings. So these retained earnings are nothing but whatever is left after paying the dividends out of the net income to the common. So that money can either be used for the company's future capex plans, or it can be put back into the company under the equity in the form of the retained earnings. Then thirdly, we also have something called as the additional paid-in capital. Now, this is something that the investors pay up and beyond or more than what company's shares face value is. So whatever additional money that the investors are paying, the shareholders are paying, so that comes under the purview of the additional paid-in capital. Then lastly, we have something called as the treasury stock. Now, treasury stock is used to repurchase the stock of the company. Also, it is generally used by the companies to prevent themselves from the threat of a hostile takeover. Now, if you look at the balance sheet needs to be balanced, and the formula for the balance sheet generally goes like the assets equals the liabilities plus the equity. Or we can interpret it like how the assets are being financed. So the assets can either be financed by pouring in the money of the shareholders, or it can be a mix of the liabilities and the equity. So this is how we define the balance sheet, and the balance sheet needs to be balanced. So I have also put a check here, which is nothing but rounding the difference between the assets and the liabilities to the zero decimal, and this is giving me a zero for all the periods. Then finally, we have the cash flow statement. Now, the cash flow statement is the most important statement because cash is the king. Unlike the income statement, which is based on the accrual accounting, everything is based on cash. A negative sign is going to denote an outflow of the cash, and a positive sign is going to denote an inflow of the cash. I've started from EBITDA. The non-cash expenses have already been taken care of here. Now I will subtract the cash taxes here, and after this I'll adjust this cash for the change in working capital. So for the working capital, we have defined the three line items here: the receivables, payables, and the inventories. So in case you're not familiar with what working capital is and how we analyze a working capital, so I strongly suggest you watch my last video in which I have comprehensively explained about what working capital is, and I've also uh, substantiated it with the help of two real life companies. And I've also explained the concept of days under the working capital. So you'll get a clarity over this topic. I'll add a link for the same in the description, so you may go and check it out. Now I've defined these three items here in the working capital, and I've linked those above on the balance sheet. And then we can find the net working capital, which is nothing but the receivables plus the inventories less payables. So in this way, we get the net working capital for each period. Now for the change in net working capital, we're going to subtract the current year value from the previous year value. So this is going to denote either an increase or the decrease in the cash. And on the basis of that, the sign is depicted here. Since we have the historical values for the CFO, the cash flow from operations, or the cash that has been generated by the company via selling the products related to the core business of the company. So this value is already given to us in under the cash flow statement. So I've hard coded these values, and for the other adjustments, I've taken it as a plug. Basically, I've subtracted the above values from this total cash flow from operations. So this is what is left. So this is how we use a plug. Then after the cash flow from operations, we have something called as a cash flow from investing. So this will include all the activities that are related to the investments. So either the company is going to expand, so for that it needs to invest into the, let's say, the property, plant and equipment, the intangible assets, or maybe the capital work in progress. So those sort of expenses will be under this head. And then I have used again the other investing activities as a plug, and I've hard coded the cash flow from investing values here. So this is going to be related to some activities such as the interest income, as we discussed above in the income statement, or maybe the redemption of certain investments, So these sort of things will be related, or maybe the purchase of investments that is going to be an outflow. So after this, we have something called as the cash flow from financing section, under which we define either the proceeds from the debt or the repayments of the debt. So this can include the interest costs or the borrowing costs basically. Then we can have certain expenses pertaining to the lease liabilities or the dividend expenses or the issuance of some stock or issuance of shares. So whatever money that the company has generated from the issuance of stocks or the preferred shares or maybe the convertible securities. So these sort of things will come under the purview of the cash flow from financing. Again, for the other activities, I have taken this as a plug. Then finally, after this, we have something called as change in cash. That is nothing but the summation of all the cash flows. Then we have the effect of exchange rates on the cash and cash equivalents. And then we have the beginning cash. So what the cash was for the last period or the ending cash for the last period of FY17, it is going to be the opening or the beginning cash for the current period. And then finally, we sum up all these things to get the final or the ending cash. Now this ending cash is going to be the beginning cash for the next period. Hence we have linked it here. This formula is going to remain the same across all the periods. This is a hard-coded value. It will depend on the different time periods. And then this is also formula driven. Then finally we take it as a summation. And here I've also added another line, that is cash as per balance sheet. So this is just for a check whether the cash in the balance sheet and the ending cash on the cash flow statement, are these coming out to be the same? These are coming out to be the same. Hence, or if we check here, the round function shows us a 0. And here I've taken the summation of all the cash flows from FY18 till FY22 for all the line items, just to see what kind of cash flows have been generated for each line item for these 5-year period. So for the balance sheet also I've taken the CAGR for this 5-year period. Now for this I'll stop here and we'll continue this series of financial statement analysis in the part 2 of the video, where we'll talk about certain ratios. I hope the concepts about these 3 statements are a little clear now. Do let me know in the comments. Thank you.